Firstly, start with growth. So, I mean, this is GDP going back to 1994. And the point that I'd like to highlight here, it's been rehashed over a couple of times, that growth between 2010 and 2019 has actually slowed down. You can see we moved from a period where GDP was around 3% to where levels now is about 0.6% of growth. And I mean, the bottom line is that in this period, growth was actually half of what it was in the 10 years into the global financial crisis. And also, if you look at the jobs picture, I mean that it's not pretty as well. What we have here is public sector job creation over from 2008 to first quarter to 2018, and also we've got private sector job creation also over the same period of time. We've seen public sector growing jobs are around 2.5%. So average growth for the entire employment sector over the past 10 years is 1%. That's driven primarily by the public sector, which grew at 2.5%. But remember that the public sector actually accounts for about 22% of total employment pool. So the biggest driver of consumption in the property space is actually the private sector. And if you look at private sector job creation, it has actually grown by 0.75% over the 10-year period. So the environment for job creation in the SA market has actually not been supportive for consumption and for space consumption in the market. What has that led to? What we have here is vacancy rates across all sectors going back to 1995. And the point here is that from 2009 to 2018, we actually saw a 100 basis points weakening in vacancy rates. That was primarily driven by the offices going in that direction. And on the retail side, if you look at it, it's sort of flattened over the time period. But we increasingly starting to see a risk that the retail sector will actually start increasing vacancy rates. We know that Apple is restructuring its business, and with that they're planning to release about 500,000 square meters of space in the market. So this puts a little bit of pressure in this vacancy rate number. What we have here is escalation rates and renewal growth rates, right? So escalation rates have been trending down. Escalation rates are red from this axis. We've been seeing a slowdown in escalation rates from there to around 7.3% over the time period. But the interesting picture here is that renewal growth rates have also been tracking down. And this is actually the entire sector. So it's offices, retail, and industrial. And that's been the picture that's been coming up. I think it just highlights the fact that the environment is actually quite challenged, not only for offices, but even retailers and industrial operators in the market. And with this, you should expect your growth in distributions to start slowing off as well. Why is all I've been talking about important? Just to highlight the point that property returns are actually coincide with economic activity. So as economic activity slows down, you should expect to see returns from the sector also slowing down. The reason for that is that so this here is actually a 10% return that was achieved last year in property, but that trend has actually been slowing down. And you can see actually growth has also been slowing down in that period as well. So the challenge is that when you compare the 2000 period and 2000 and 2007 period versus the 2010 and 2018 period, when you are a landlord sitting in this, operating from this in this area period here, when leases come up for renewal, you're actually renewing in a very strong economy. So you're actually able to capture upside growth in rental reversions, which is the picture that I showed earlier on. But then the problem here is that as economic activity slows down and leases come up for renewal, you're actually renewing to a very, very slowing economy, which is affecting your reversions and ultimately the returns that you can actually generate from the sector. So long-term total returns from the sector was about 14%. But over this period here, 2009 to 2018, we've seen that coming in at around 13%. But the trend over the last 3 years has actually also slowed down further as a result of a weakening economic environment. So with that backdrop, what have South African REITs actually done to actually navigate that slowdown in economic activity. Before I get to that, I mean, REITs have a mandate, implicit mandate to grow their distributions on an annual basis, right? So I'm sure you'd appreciate the fact that in an economy that's actually struggling like we've been struggling, it's difficult for real estate investment trusts to actually achieve this growth in distributions that they offer, that they sort of promising to their investors. And with that, we've seen over the last couple of years, a lot of them have actually gone to offshore markets in search of this growth. The picture here shows the listed property index, right? And the constituents in that index that have exposure to offshore markets. In 2013, there was about 6% of the SEPI that had exposure to offshore markets. When you fast forward to today, there's about 42% of the SEPI index that have assets that are exposed to some offshore market, be it Poland, Romania. And the result of that, the primary reason behind that is actually guys actually going offshore in search of growth. What has that done for distribution growth? So, as I said, if you expect the economy to start slowing down, you should expect to see your distribution growth also slowing down. But the red line here highlights GDP growth. The point I want to highlight is between 2012 and 2013, we saw property real estate investment trust growth actually performing counter-cyclical to what the underlying economy is actually doing. So we went from a period where it was growing at around 5% to around 10% in 2015, but we've seen that slow down as companies actually were operating from a high base from a distribution growth perspective. This slowdown here in 2019 came as a result of obviously the noise that we had last year, where a lot of the funds had non-core income into their base, and as the market actually scrutinized the non-core income that was in the base, funds started releasing that, and that's why you're seeing this significant slowdown in 2018. But we also get a question that, I mean, why are South African companies actually going to offshore markets? But the point we want to make here is that not only South African funds are not the only ones that are actually going to offshore markets. Property may be a domestic sort of asset, but increasingly the capital that owns this asset is becoming global. So what this picture shows is outbound capital, which is effectively an investor sitting in the US that wants to buy assets in Europe. And this is actually a European picture. In 2018, we saw about 344 billion euros of outbound capital. Right? 47 billion of that came out of the US, 19 billion came out of Asia, and Middle East and Africa accounted for about 7 billion. The South African component of that 7 billion of that is about 3 billion rands, which shows that, I mean, which actually went into Central Eastern European markets. But sort of painted a very 2008, 2009. So we think that all the negative noise have actually been priced into the index going forward, and the drivers of returns from this point onwards will be driven by income as opposed to capital growth, which sort of cushions a negative impact of a slowdown in either capital growth or your distribution growth. So let's check the time here. So where to from here? I think as South African investors, we are probably 20 to 30 years behind the cycle in terms of how we look at investing in real estate, and especially from a direct real estate perspective. And I think there needs to be a shift in how we as investors think about how we want to earn returns from the sector, and how, as asset managers also, how do we generate returns for investors in the sector. So I think we are likely to see a rise in private real estate funds that operate up and down the capital structure, be it in debt or in equity, primarily with the intent to offer investors specific returns. So if you're an investor in property and you only want to have access to income, which is much safer than returns can be carved out to accommodate that kind of investor. But if you're an investor that wants access into the sector, but you're willing to take up risk, there can be strategies that can be carved out to accommodate that. So how do we see this unfolding? I think we're likely to see strategies that are unfolding. So the only difference between, I'm sure the guys that are sitting around the table actually have access to private equity funds within their portfolios, but I think going forward, what's going to change is actually the strategies that will be employed by these funds to actually generate returns for you as an investor. So core and core plus funds, typically low risk, and also low return. So these are fairly stable assets that don't have very much risk inside them from a leasing perspective. The other strategy will be a value-add fund or value-add strategies, which employ a little bit of intensive asset management to start generating returns for their shareholders. But with that strategy, there's some level of leasing risk or development risk or some form of leverage that you'll be taking on as a fund or as an investor in a fund that's invested in value-add opportunities. And lastly, our opportunistic funds, which effectively gives you possibly the highest return, but also the highest risk that's available from the asset class. And just to contextualize that, what do I mean by that? So a value-add fund would be a fund that's primarily given a mandate to go buy assets that are secure. As an investor, you don't want to expose yourself to a lot of volatility from a capital return perspective. You want assets that are very stable, that don't have a lot of leases that are coming up for expiry in the next couple of years. And the example I used here is V&A Waterfront. Right? So in addition to being a sort of the other explanation of a core plus fund is that the amount of debt that's been used in the capital structure is fairly low versus what you can get as you move up in this risk spectrum. So this is an example that's actually much closer to home. This is Village Walk, which is in Sandton, was in Sandton. Pardon? Yeah. No, not Momentum Head Office. Okay, I'll show you Momentum Head Office after that. Effectively, you're right. But this was the old Village Walk building that was not relevant for the kind of market it was sort of situated in. So funds that will look at these kinds of opportunities will also have a mandate that's specific to say we want a capital return or a higher return, and we're actually giving you allowance to actually start tapping into this market. So your total returns from this kind of a strategy will be obviously a combination of both income and capital return, but the bulk of that will be capital return, but because you're putting a lot of capital into play to generate your returns. And then the last one will be a discovery office building in Sandton, the opportunity that these guys would sort of go after. Just to show you the complete picture, there's the head office as you were mentioning. So this would be the mark, yes, after being redeveloped, being repositioned for the location that it's operating in. And then ultimately you also have a discovery building. It's a building that obviously that would, you have taken a lot of risk to actually get this building off the ground, but the returns as you sell it down over time would be superior than what you would have received from both these strategies. Just another point to highlight is that the mark is not fully complete at this, well, it's complete but not fully let. This portion is actually sits in the Momentum Property Fund. If you want access to that, we've got Andrew sitting here who's a portfolio manager of the direct property portfolio. But because this is not complete, it will still stick within the value add opportunity basket. Up until it's fully let, can it then move from this level down to that level? Because it will be a stable asset that actually guys would be comfortable to buy, that there's no risk in it. So the full picture would be Discovery would have moved from being an opportunistic asset to being a core asset. And the ENS building which would have been in this bucket maybe 15 years ago, because ENS has now moved to the mark, now sit in this basket. and then there'll be people or funds that will actually go out there and try and add value to this property to improve its quality and get tenants inside as well. So what have our returns been like? So just to wrap up, these shows are listed property returns from the 1 year, 3 year, 5 year returns. As you see, we've actually generated alpha of about 1.5% over a 1 year period. Over a 3 year period, we're up 100 basis points. And in the momentum as a real growth property fund, which is a fairly newish fund in terms of track record, we've generated alpha of about 135 basis points. But I think I actually gave you a picture of how we think additional returns from the asset class can be generated. I think the challenge is a lot of the investors, when they look at property, they just look at this one solid block that they can actually allocate whatever, maybe 10% of their exposure to. But the returns from the sector can actually be carved out to accommodate various investors' risk and return appetites. Yeah, I think with that, I'll close there, and don't know if you've got any questions, Renee, on Slido. Do I expect listed property to perform different from other equity sectors in the near future, and why? Oof, I'm not an equity specialist, but I can tell you that property at these levels, I think it's really attractive. We think we can actually generate, without the sector doing much, you just take a look at the yield that the sector is actually offering compared with the growth that we're forecasting of around 4%. Without any re-rating or de-rating from the sector, you're easily sitting at around 13% kind of returns. And as I said, given the sell-off that we've seen between 2016 and 2018, we think all the noise in terms of growth has actually been priced into the sector. So I'd be concerned if I was sitting here maybe 2015, 2016, where there was a lot of growth that was embedded in the distribution number, and the yield was so low. I'd be concerned to say I think there'll be additional upside from the sector from that level. But with the sell-off that we've seen, I think there's some level of cushioning for investors investing in the market currently. Is another one. So thank you very much, everyone. And I'll hand over to Ian.